everyone, welcome to the Grow Your Future podcast. My name is Zah and I am your host, and I'm joined by my confidant, Daniel. How are you?
Good. How are you yourself?
Yeah, good man, good. So what are we doing today with this podcast? It's going to be a Q&A, I believe, and you've been getting peppered with questions since your introduction to the company. And we have a lot of younger people asking you questions about property investment. So today we're going to discuss those questions. We're going to go into them in detail. We're going to talk about our experiences, the current financial climate on borrowing and all of that sort of thing. So let's get started.
Awesome. So today's going to be a good one because we've got about 37 questions.
Oh, hopefully we get through them.
So we'll have to probably do a couple podcasts to make up for it.
That's a question a minute.
That is. But I think the first question that most people have been asking is, how do they get started and how much deposit do they need to get into the market? Because at the moment, people are saying, do I buy a $500,000 property? Do I wait till I can buy $1 million? What's your take on how much do they actually need to get into the market?
Look, everybody differs, right? Because everyone has different, borrowing capacities, different equity positions. But let's say, generally speaking, we assume that the purchaser is going to come up with savings, right? It's not equity in a home. It's not a bank guarantee from, mum and dad. It's just savings. Now, I always recommend a 20% deposit. So a good sweet spot at the moment is $500,000 to $600,000 in terms of a purchasing price point. That can get you maybe a house and land package in somewhere like Brisbane. It could get you a really nice townhome in Brisbane also. So you can get a quality asset for around $500,000 to $600,000. Now, 20% of that is around 100 to 120 grand. And also you'll have stamp duty as well. So you're looking at around $140,000, $150,000 if you want to use a 20% deposit. Now, I'm not against using a 10% deposit. So essentially you just halve that, right? So 60, 70K can get you into the market to a decent property. Now, I know there's other properties out there that are around $300,000, $400,000, but generally speaking, we're not going to get much for that. You can get some apartments for that, but as a first investment, you'd really want to go towards maybe a townhouse or a house and land.
And I think just on that, just as a point, if you guys are considering a smaller deposit, at times it actually can be beneficial for your cash on cash return as an investor. So if you don't have 20% deposit, a lender will want to see either LMI, which is lender's mortgage insurance, or a risk fee, depending on the funder you use. Now, if I do come in with only a 10% deposit, they can cap the LMI in the loan amount, and your actual cash on cash return will be higher as an investor leveraging more money. So as good as it is you should probably start by thinking of saving 20%. If you've got 20%, I might actually recommend you only using 10% and keeping that 10% in an offset account or contingency for if things change in the market or your financial situation. So what are your thoughts on that?
It doesn't mean you have to use that extra 10%, right? If you've got it, great. I think it actually works out better that way. If you've got 20%, use 10% for a deposit and use the other 10% as a buffer. And what I sometimes see people do is they stretch themselves to just get 10% deposit, so say 50, 60K, and then they go sink that into a property and then they have $0 into the account. Yeah. And what happens from there is that they're stretched. If they have a vacancy or if the toilet breaks or whatever, they've got no money left. So to safeguard yourself, I would recommend, do the 10% deposit, but then have 10% in buffer funds, because you never know what life can throw at you.
So we've come up with the deposit and we know we're ready to invest. How do people go about, because there's a lot of people that are asking, should they buy where they live, or how do they come about buying in Brisbane, which is more outside of Sydney or where they live? So what would your recommendations be in regards to buying outside of what they used to?
Right now, we live in Sydney, right? So Sydney, I feel, has come off the burn, and the yields just aren't here in Sydney. Like, you're buying property for, say, $600,000 or so if you can get something in Sydney for that. But then your yields are like renting for $300-400 a week. It's just, they're not very high. So the cash flow position isn't as high as it used to be. Now, our yields are really high in places like Brisbane, especially in the affluent areas. Like we can still achieve 4 to 5% yields, which is extremely good for a blue chip location. With properties in Sydney, for example, you can't achieve those yields. And a lot of our audience live in Sydney, right? So they go, oh no, well, I want to buy down the road. Well, in a way that's good because you can touch and feel it and it's, you know, it's within reach. And, you know, if you ever need to go there and repair it and all of that sort of thing, and you know the neighborhood, that's what a lot of, like, that's what I did anyway. But I bought in a time where yields were quite high. So, you know, we're in a different era now. That was 12 years ago for me. Now we've shifted and we need to sort of look at other markets. And now it's purely an investment. Like we're not looking at living in these properties. So it doesn't matter. It all comes down to the numbers. Are we getting the yields, right? Are we buying in an affluent location? Is there scarcity in terms of supply and demand? We need to look at all of those factors and fundamentals to ensure that we're investing in the right asset. Now, if that's going to be, you know, in another market, then great. And that's that's where it's pointing right now, Dan. Like we can't expect to get the same returns we got 10, 12 years ago in Sydney, you know, to today. Like it's just not going to work. So we need to go and look at other markets.
So if I do, for example, buy in Brisbane, how would I then manage that asset when I live in Sydney?
Well, we engage property managers and you'll pay a fee. Like even here, if you bought an asset here in Sydney, like you need to manage that through a property manager. Now, you know, in terms of buying the asset, you would see people like us because we're in the market and we know where to buy. We know supply and demand. We know, you know, the quality developers and the builders and all of those sort of things. You wouldn't just go and do it on your own. It's really, really hard. I mean, unless you're in it full time, like we are, then we wouldn't recommend it. So in terms of the whole management process, that can be outsourced. So don't be afraid that to engage certain people to do the work for you, because even if you had the property here in Sydney, you would still have to outsource that work. Like you're not going to manage it yourself. We wouldn't recommend it.
Yeah, and just for the listeners out there, what you would do is you get a property manager, right? So how much would a property manager cost and how do you find good property managers?
So it varies. From market to market it varies. Like here in Sydney is different to say in Brisbane, but generally it's like between 5 to 7 or 8% of the rental income. So property managers, you know, basically take a portion of that every month and that's their income. So what they do is they collect the rents, they screen the tenants, they do the inspections, they organise repairs and maintenance, and they're basically your representative in the other state. You know, a very, very important role within your, you know, property investing team.
Yeah, definitely. So I guess on the topic of interstate and purchasing properties that may not be what we're used to, one of the questions came up is, do I go rural or stick to the city?
Look, I'm against rural because I just feel that there's not enough population there to feed growth. What we want to do is we want to have proximity to basically the 3 major cities, Brisbane, Melbourne, Sydney. If you can be spread across those 3 markets, like let's say you had 2 properties each market, so 6 properties all up, you're well diversified, you're well protected from, you know, one market going down while the other one might stay flat or it might even increase. You know, and you might want to get a mixture of apartments, townhouses and houses. That's a perfect portfolio. So, you know, what we want to do is we want to stick to those 3 major cities because that's where the money is. Like, let's face it, being out in the sticks, like 200 kilometers out west, is not going to provide us the returns that we need. And it might be an okay place to live. Like I've got friends that live in rural areas and they're very, very happy. But we're not talking about living. We're talking about investing. We're talking about numbers. We're talking about profit margins. And we want to make sure that we get the maximum amount of return in the shortest period of time.
Yeah, awesome. And I think on that, guys, just a point with rural lending, rural purchases, it becomes more of a business transaction because a lot of rural properties, the money is derived off the production on the land rather than a tenant leasing that property. It's a lot of, for example, rural properties are vineyards or farms where the income's derived off the land content and what businesses use that that land. So I think if you are going to invest in rural areas, you probably want to go there from a business. I'm going to go purchase this land with, I've got all this cattle that I want grazing on that farm, rather than just purchasing it to get more of a passive income.
It's a different strategy, right, Dan? Yeah. It's more of a commercial strategy, and what we're talking about here is residential real estate. And residential real estate doesn't need to be complex. It's actually quite simple. You know, follow the fundamentals, make sure the yields are there, supply and demand, you know, don't buy on a main road, like all of those things, right? And you'll win at the end of the day. Yeah. Sometimes people make things so complicated because they think the more complex a deal is, the better the returns. It couldn't be further from the truth. It's just not how property investing works. It usually is the more simpler assets are the ones that provide the greatest returns.
So just on that, what do you reckon the impacts are going to be from COVID and the market?
In regards to residential property, I actually think it's going to go through the roof, because what happens in times of recession, people need to put their money somewhere that's a safe haven, right? A lot of people say, you know, commodities like gold and all of that sort of thing is really good. I beg to differ, because gold doesn't produce an income and it doesn't have a yield, right? Whereas property does. Like, for example, we just spoke about earlier, Brisbane, affluent locations, we can still achieve between 4 to 5% yields. Now, we're borrowing money at around 2% at the moment. So you're pocketing 3%. Now, that's an amazing return. And we're at vacancy rates of below 1% in some markets, meaning that why wouldn't you put your money in there, right? Like, where else are you going to put your money in there and get that type of return? Now, track record from post-recessions have always shown residential real estate to rise. So why wouldn't that happen now? We've got ultra low interest rates, right? We've got the same tax benefits allowed to us. You know, inflation's going to be steaming ahead soon because the government keeps printing cash. Like, it's all heading in the direction where prices are going to rise. Like, I have every confidence in the Australian property market right now for the next 1 to 6 years.
Awesome. So just on that as well, one of the questions came up is, what tax advantages could we be looking for in regards to buying property?
Okay, so one of the biggest tax advantages is depreciation, right? So we're currently building a 5-bedroom luxury home for a client of ours, and the build cost is around, I think it's around 400K, right? Now, that property has all the high-end finishes. It's a luxury home in an affluent suburb of Brisbane. Total package price is around $800,000. Now, the first year depreciation is going to be about $20,000. And that can go for about 40 years, right? Now, that's probably one of the biggest tax breaks that you can get. Now, if you had, say, 5 of those properties, that's $100,000 in depreciation that, you know, you basically wipe out your income if you're on 6 figures, right? So I think depreciation is a massive part in property investment, because it just contributes to your yield. Like, $20,000, maybe it might give you close to a $10,000 refund, for example. It gives you $200 a week. That's $200 a week extra you didn't have, right? So put that on top of your yield, all of a sudden it grows.
Definitely. So should I be investing in new builds or existing properties then?
Look, they both have great attributes. Now, the great thing about new builds is you do get that maximum depreciation because it is brand new, but you also get the higher yields because people generally want to rent newer properties over older properties. Also, my experience with established properties, they're very high maintenance. Like, I've got properties in my portfolio that were built in 1930s, 1940s, and they continuously need work. Now, I've bought those properties more so for the land content, not so much for the building, so I'm quite happy to keep feeding them. But, you know, if you're a novice property investor, that can get quite tiring. And also the low returns over the long periods of time can really do your head in. So I think I always try and recommend, look, there's some really good new properties out there in really good markets. Let's see what we can do with that strategy first. And if we absolutely must go down the, say, renovation strategy or the redevelopment strategy, then we look at intrinsic value through established properties. So both of them have their pros and cons.
Yeah. So just on that then, what areas, what are the mistakes we can do when we're investing in brand new establishments? Like, what should we be looking out for?
Okay, so the biggest mistake I see people make when they're buying brand new is they buy something that has a lot of stock within that area. So for example, house and land packages that are out, in whoop whoop, where they've got unlimited access to land and developers just keep on buying or releasing more land. And it's just an unlimited supply. And what happens there is there's no supply and demand. It's just there's no scarcity. All that we see is more housing. And what that does to pricing is it makes it just stabilize. Like it just there's no growth, right? Where you want to buy is in, for example, with house and land packages, you want to buy in infill estates. Infill estates means in established locations, right? So there might be a land developer that releases 20 lots within an established location. So there's scarcity attached to that land. Gotcha. That's what we want to buy. We want to buy something that's a hot commodity so that if we have to liquidate it, we know we can liquidate it at a very high price because there's high demand for it. But if we're buying in, say, a high supply area where there's just unlimited supply, the demand's actually going to be always quite low because there's going to be an unlimited supply. What's that going to do to pricing, right? Definitely. You'll never make money. Or you might make money in, say, 20 or 30 years. So it'll take a very long time. That's the biggest mistake I see people make. They buy in an area because it's well marketed. They buy through the glossy brochure. And what happens is that they don't realize until, 5, 10, 20 years later that they've bought in a dud spot.
And I guess on that, an area which may be an area to avoid is a lot of stock in Melbourne. There's so much supply of land that's not capped. So developers have already purchased all the farmland and the land that could go all the way up to, say, Canberra, for example. So what will happen is you're going to have developers developing brand new commodities in a primary market. And if you are to say you've purchased a property there, in 2 years' time, there's not going to be a demand for your property when next door there's a brand new one for sale. So if you're investing your money there, you're going to be losing in the short term, where instead of parking it in, like you're saying, a established market where you're purchasing stock where there's only maybe 20 built in this location, then there's a lot more demand for that product and there's a lot less supply.
I think that people mistake when they're investing in property. What happens is that people look at something that's worth, say, 500 or 600K, and they go, man, I'm getting so much value. Like I can buy a 4-bedroom home in this market on a 600 square meter block. But what they don't understand is that it's cheap for a reason. It's cheap because that demographic can only afford that amount of money. So what I tend to do is push people into spending a little bit more, right? So that you can get into markets where those assets will always increase in price. Like for example, I would much rather someone buy an apartment in a really good location rather than a house and land package that is, say, 250 Ks west of a CBD, right? Because I know that apartment you'll be able to increase the rents. That demographic will be able to sustain those rental increases, will be able to sustain that capital growth and keep paying more for that asset rather than that demographic that lives right at 250 Ks out west, right? Where there's not much economy out there, right? So I'd much rather someone do that if they only want to spend, 450 grand on an asset, because it's not about the asset, it's about the numbers.
Yep. So then on that, what's your opinion on purchasing off the plan?
I love off the plan, right? And a lot of people shit on off the plan. Like it's really, really funny to listen to people like that really don't know off the plan very well. Now, I'm not saying all off the plan is great. It is actually quite hard to get right, and there's a bit of an art to it. But what I like with off the plan is that you can be in the market and 2, 3, 4 years later when it completes, right, you've had no holding costs and you've been in the market and the market's risen. And when you settle on that property, hopefully if you've done it right, it's worth more than what you paid for originally. That is actually a very hard strategy to do, but it can be done. And there's a lot of markets where off the plan actually really, really works. For example, Melbourne apartments do really well at the moment because houses are through the roof, right? But apartments haven't caught up yet. So if we're buying apartments at today's rates, but they're ready in, say, 3 or 4 years' time, like, there's only one thing that's going to happen to the Melbourne market once it recovers from this whole COVID lockdown thing. Like, it's just going to go ballistic. Melbourne's going to be the next New York. Like, it's going to take over Sydney in terms of a population. It's actually forecasted, ABS have forecasted that Melbourne will take over Sydney in the next 10 to 20 years in terms of population.
Wow.
It will hold over 8 million people.
There you go. So on saying that, what does that do for us as investors? How does that information help us invest? What does it do to the market?
Okay, so what's going to happen with Melbourne is that if you're not in the Melbourne market within the next, let's say, 2 to 5 years, I think you'll never get in. It'll just take way too long for the cycle to come back again to allow you to get back into it. The yields just won't be there, and it'll just be so unattainable that the only market that you'll be able to go to is by heading up north. And it's very similar to what's happened in Sydney, where everything in Sydney now is expensive. Houses, apartments, townhouses, everything, right? Even avocado on toast is expensive, you know, like it's 25 bucks, right? It's ridiculous. But in Melbourne, there's some affordability right now. And if you get into the market now at today's price, especially now with this whole COVID lockdown, there's so many good deals there. Do you think this COVID thing's going to be around in 2 to 3 years' time? It'll be long gone, right? And the market will have recovered. You've got cheap money. You've got no stock. There's no new projects getting launched. So if you can get into an off-the-plan purchase by a quality developer and wait 2, 3, 4 years, you're going to win, right? And the problem is that people can't see that. People see all the doom and gloom, and they just avoid getting in. But what's going to happen in 3, 4, 5 years' time, you're not going to be able to buy anything in Melbourne. Number one, there'll be no stock. But number two, you've missed out on the pricing. It's going to be too expensive. Because as investors, we don't want to buy at the top of the market. Yep. Hence the reason why we're not buying in Sydney.
Yeah, definitely. So let's say we do there's urgency there to enter the market. What are some things we can do to maximize our position to enter the market?
So what we can do, well, let's go back to off the plan, Dan. Yeah. Off the plan doesn't require any borrowing for now. So if we say we pick an investment that's going to be complete in, say, 3.5 years' time, then all we're doing is putting, say, a 10% deposit down. So for a $500,000 purchase, we put 50 grand down. Put 50 grand down, bang, that's done for the next 2 to 3 years, or however long that project takes. Now, that's a really good strategy if your finances aren't in order to get a loan today, because that gives you time to go, okay, I'm in the market, I've invested, I'm a property investor, right? Yeah. But I haven't got a loan. I've got 2 to 3 years to get my finances in check and then go to a broker so that I can prepare for that day in 2 to 3 years' time. That's a really, really good way to get into the market if you don't have any borrowing capacity. Sort of forces you to get things in order.
And you know what I like about that strategy, particularly now with the interest we get on our money being in the bank so cheap, it's a great way of deploying that into an investment vehicle today.
Exactly right. Like if you had 50 grand, why would you put it in the bank today? What's it paying, Dan, right now? 50 grand? Like not even 1%, right? So if you had 50 grand in the bank, after 3 years, if it's paying you 1%, you're making nothing. Like it's not even worth talking about, right? But if you put 50 grand into a $500,000 property today, that property, if you've bought right in 3 years' time, is going to be worth what? $550, $580, maybe $600,000. 100 grand you have made on 50K, you've tripled your money. You haven't doubled your money, you've tripled your money. Now these numbers are exaggerated, but it's possible. These are the type of returns you can get if you don't put your money in the bank, right? You'd be stupid to leave money in the bank when you could deploy a strategy like this. Now, the beauty of the Melbourne market is that we can sell that contract later. So we don't have to settle on that property if we don't want to. We can nominate that contract out. So you can potentially get your money back in terms of your deposit. Let's say you're not finance ready. In Victoria, you can nominate that contract to another buyer without incurring any stamp duty. You could also make a tidy profit on the back end as well. That's the beauty of the Melbourne market right now.
Wow, very good. So how would we go about finding these properties?
Well, you come to us. right? Like we're in the market every single day. We've got the relationships with the developers, and a lot of great properties don't hit realestate.com. They're all off market, right? We're in the market every single day. We do this full time. And unless you want to give up your job and do it full time, like I wouldn't recommend doing it on your own. I would always recommend, engaging a company like us, as in Luxland, because, we're very well versed in it. I always invest in every project that I recommend to my clients personally as well. So you've got that peace of mind that, we're doing the right thing by you.
Definitely. Awesome. So just on that then, what would your advice be on buying and flipping? Because at the moment, people are asking, there's going to be some stock coming on the market where people may not be able to afford their current home, and there's going to be established stock that we could potentially be flipping. Now, if interest rates are so cheap, is that a viable option? And what are your thoughts on flipping property?
Flipping property can be good if you're working with big numbers. And I've done it before as well. I've done a lot of renovations, I've done development and all of those sort of things where I've sold the property. Now, we're big advocates of buy and hold, right? That means accumulating assets over a long period of time and allowing that compound growth to sort of feed our retirement. Now, what we want to do with flipping is basically get in, maybe do a renovation or do a subdivision, do a development, and then sell it on the back end. Therefore, we're not too interested in the location or the market because we're not holding the property. We're just creating equity from renovations or development, and then we're moving that property on to an end buyer. So, for example, we actually do this strategy for our clients. We do duplexes where we buy a block of dirt and we'll subdivide it, we'll build a duplex, and then we'll sell them off separately, and we'll make maybe 150 grand on the back end. Great strategy. It doesn't even cost you $1 million, and you can make $150,000. It's good for some fast cash, but what you've got to understand is that you've got your tax implications as well, and that's why I say at the start of the answer, the big numbers is where it really gets attractive, because if you're not doing big numbers, by the time you pay your tax, your marketing fees, your agents, and your time, you don't really end up with that much. So let's take that duplex strategy, for example. If you make $150,000 in profit, after you pay all your taxes and you pay all your fees and you get out of it, and you've paid stamp duty on the way in, you're probably sub 100K. Now, to some people, that's worth doing. To me, not so much. Like, if I want to be flipping properties, I want to be doing big developments. I'm talking 4, 5, 6 townhouses. So there's enough profit margin to be able to eat into, so we can end up with that smaller profit. But when you're doing, say, renovations and all of that sort of thing, it's a case-by-case basis.
Definitely. So just off that, then what are some of the problems we should be avoiding when we're looking at purchasing our first property? Because a lot of people now are starting to say, do I go commercial, residential, apartment, house and land, townhouse, flipping? So what would your advice be to the mistakes you should look out for?
I think the mistake is exactly what you just said, choosing the right strategy. There are a million different ways to skin a cat. And when it comes to property, because there are so many strategies out there, people don't know what to do. It's very confusing. And because there's a lot of strategies that actually work, then people get even more confused, because they'll do one strategy, but then they'll go, oh, is the grass greener on the other side? And I know I've done that, and I've done nearly all of the strategies, so I know what actually works. It depends on your risk appetite and how much labor you're willing to put into the project. Now, a lot of people can't stand the thought of doing renovations. I can't even stand the thought of doing a renovation right now. It just seems too laborious for me. I would rather just do, say, a house and land, for example, because then I can contract all the work out. I even have project managers to deal with all of the little issues, and then it's just all done and dusted. Plus, I get to take advantage of all the depreciation, high yields. It's just so much easier. But some people might want to do a renovation first. So it all depends on the individual. There's no one strategy which is the right strategy. It depends on what you want to do and how much involvement that you want.
So what advice would you give to a first-time buyer? Because one of the questions came up was, do I buy where I live or do I rent where I live?
I'll always recommend to rent vest, and that means, rent where you want to live, but buy in another market that's going to give you a bigger return. Now, right now, like the majority of our audience are based in Sydney. So to buy in Sydney, you're not really going to get the return that you're going to get, say, in other markets, like, say, Melbourne or Brisbane. Now, some will argue the point because they'll say, well, Sydney's always going to go up in value, and that's true, right? But the problem with buying the home that you live in is that you roadblock yourself in terms of serviceability. So you're going to have to wait till you earn a lot more money or build a lot more equity in that home before you can keep investing in more property. Yeah. And I've seen it time and time again where people have basically mortgaged themselves up in a place that they're living in, and the banks won't give them any more money because that mortgage that they've got on that property doesn't provide any income to support that mortgage. It's actually dependent on them as employees or business owners to produce that income. So if you want to get ahead faster, then I would say invest in property and just rent where you live. Like right now, I was talking to a friend the other day, Dan. He pays in rent $800 to live in a $2.5 million Sydney home. Wow. Now, why wouldn't you rent? That's amazing, right? Because if you bought that $2.5 million home, there's no way the banks are going to give you any more money unless you've got a super high income. And, we don't want to work ourselves to the bone in order to be servicing this massive debt in order to buy this home that's cost us so much money, and then we want to invest in property. We're just creating too much work for ourselves.
And it's interesting you mention that because with the banks and lending, they generally only take about 30% of your wage as serviceability, where with your rental income from property investing, they'll take up to 80%, if not some cases 100, depending on the funder. So actually, you actually can use more income to service your new loans from rental income than your actual wage.
So it makes sense to rent vest, right? Because the rental income is actually looked at more favorably than your actual income that you go to work and earn. So, why do we buy homes to live in? Like, people should only buy homes to live in if they're rich. Like I've got friends who build $2, $3, $4 million homes, but they can because they're rich. They've got money. They've got investments. They've got businesses. They're doing okay. But if you're on double income, you're just employees, and you're trying to just get ahead, and you're not going to get in this inheritance of generational wealth, then my recommendation is always buy the investments first and rent where you want to live. And besides, where you rent, like, you can move around. Like, if you want to move to Brisbane, you can. If you want to move, overseas, you can. You can just drop that lease and just leave, right? But when you own your home, you are tied to that mortgage. And unless you've got plenty of cash behind you, it just doesn't make sense. I think the houses were introduced to benefit the banks, because what happens is these people that buy houses, they get chained to the banks. They are the slave to the bank. And that's what happens with when you have a house, you become a slave for 30 years to the banks. And who wins out of that? The banks, right? Because all of a sudden, you are forced to go to work to keep paying that mortgage. You are forced to keep running your business to bring that income in, to keep paying that mortgage for 30 years. The banks love it, right? But imagine if you were free. All of a sudden, it doesn't matter because income's paying for your mortgages from your investment properties. That's ultimately where you want to be. That's where you're going to be free. And the problem with society is that everyone tells you, buy a home, buy a home. Society doesn't tell you to do that. That was started from the banks that are telling society to do that. That's how this marketing is played, right? So the banks let's face it, the banks have so much control over how we think and what we do. And they're pushing society to tell you to do this. And that's why this whole rent vesting strategy, you don't hear about it much. Because who wins out of it? Us individuals win out of it, not necessarily the banks.
Yeah, it's a great point you made with the banks, because with the banks being listed on the exchange, they have an obligation to maximize their profit. So for them, even things like offering, as an investor, right, there's different types of financial instruments we can use with the banks that benefit us, but don't make the bank as much money. An example is using an offset account or interest-only loans. So on your point, it's very true how the banks have established themselves in the market to get you guys to buy owner-occupied properties and then think about investing.
Well, we've got to think about it, Dan. How many investors are there in the Australian market? There aren't that many. As much as we love it and we surround ourselves with like-minded people, there aren't a lot of investors in the market. There are more owner-occupiers, which makes the banks favour the owner-occupiers because they're the guys that are going to make them money because it's the majority of the population. So what we want to do is go against the herd, right? And not do what everybody else is doing. Become slaves to the banks. We want to go, no. We want to utilize what the banks have to offer so we can generate income. We need to be smart about it. We need to be the 1%, right? And this is what we're trying to educate our market on. You know, be the 1%. Don't be like the herd. Don't move with the herd. Move with us.
Yeah, definitely. That's great points. So just lastly, one of the questions I've got here is, do I need to be earning a full-time wage to start investing, or should I be focused on establishing my business first? Which one should I be focusing on?
Oh, it's an interesting one because I'm always telling people to invest in themselves and then invest into their business and then invest into hard assets, right? However, sometimes people have this really good job and which pays them a really good income, and the pay slip is like your golden ticket when you go to the bank because banks love pay-as-you-go employees over self-employed. They always will. They love stability. They love security. So it really helps them assess, the loan. So they go, yep, granted. And this is the issue that I get put across my desk on a daily basis. Do I leave my job and invest into my business, or do I buy a property? Again, it's a case-by-case basis. I'm pro-business. I love it when people say, yep, I'm going to break free from working for the man and I'm going to go start my own thing. But if that means that you're going to give up, a really good income that the banks really love, then I'll say, go and buy a property first, make some money on that deal, and then we'll tip that money back into your business on the back end later on. And I've done that for some clients, I've advised them to utilize their payslip, utilize their career to go and leverage themselves to go and get property first and then go and start a business. But then there are some people that are very, very early on where, they've just got a cracking idea and there's no choice but to really move on from their job and go into business. Then I say, okay, invest in your business, and then so that business throws off income, and then take that income and park it into hard assets. Again, case-by-case basis.
And it's an interesting question because I actually had that question for myself when I was starting out, because there was a point where I came to you saying, Zah, do I go and buy this restaurant, establish a restaurant with this burger business we had, or do I actually buy a property? And the advice you gave me at that time was actually, Dan, you're actually a businessman, but let's invest into an asset which is secure, and then let's go gamble on our businesses being obviously younger at that time. But that's an example of what happened with me.
A great example, Dan, because right now you've got that asset, right? And you actually came to me again and said, okay, Zah, what do I do next? Do I go and buy more property because now you've got some equity behind you? Or do I go and invest in myself and into my business, right? Now, you yourself are a business, and I advised you. I said, no, let's not buy the property. You've already got an asset behind you. We're good. It's generating income and it's appreciating in value. We're happy with that. Let's now get you into business mode. Let's get that equity and pour it into yourself. Let's do self-education. Let's spend money on your personal brand. Let's get out into the marketplace so we can get more business coming in, so it throws off more cash. So then we use that cash to go and buy more property. So you get through different stages in your life, and whether that's through investing in yourself or buying more property, everybody's different. But it's really good to have these conversations with people who have done it before.
Yeah, definitely. And I think if you guys do have those questions, shoot them through. And I highly recommend getting a mentor and someone that you can bounce that off, because I know for myself, it's a defining moment in your life. do I go down this path or this path? So,
Well, it's a lot of money, Dan, right? So let's say we've got 150 grand here, and we can go, okay, well, we can put it down two paths, right? We can put it down a path where it's just buying a property and, you know, get some income coming from it, and then we don't have that 150 grand anymore, it's gone. Or we can put it down this path where it goes into a business, but it's guaranteed an income because we're upskilling ourselves, but it guarantees an income for life because you'll never lose putting it into yourself. So we had to think, okay, where do we go? And, you know, if you didn't have a property behind you, I'd probably say, yeah, maybe we get an asset, right? Because we've got time to make more money later anyway. So, you know, everybody's different.
Awesome. So I think that'll be enough questions for today. Is there anything else you wanted to add on top of what we've talked about today to kind of clarify for the listeners?
I think for our younger listeners, I think, you know, there hasn't been a better time to invest in property. You know, you've got low interest rates, you've got a lack of supply, so meaning that, you know, prices are just going to get pushed up naturally. If you've got money, if you've got the capacity, now's the time to get into the market, because if you don't, you're going to miss out on this really, really big boom. Like I'm predicting a big boom. You know, it's all facing in that direction. And right now, the majority of the market is operating in fear. Yeah. So now is the time to get into the market because there is opportunity. There are people who are unsure, they're uncertain. But take it from me, take it from someone who's in the business, in the industry of property. Get in the market now if you can.
And just lastly on that, sorry, Zah, is that I want you to touch on that point of supply, because I know in Brisbane, where we're looking at some of the properties for clients, is that there's a shortage of supply due to stopping the development approvals. So could you just touch on that? That we need to focus on the urgency.
Well, we were pre-COVID. We were already in a short supply phase of property. Like there was, because we came off the back of development approvals not going through last year when we had a little bit of a downturn. So we were already in a state of undersupply. Now, COVID has really pushed it forward where no new projects have been launched. So in the next 2-3 years, when projects were supposed to be completed, there's already going to be a low supply. So we're calling it the great undersupply. And meaning that when there's an undersupply of stock, prices naturally get pushed up. Like for example, new cars at the moment, there's no new cars at the moment in any dealerships. Like they're running out of stock because no new cars are coming in. So now used cars are going up in value. So that's a really good example of when you cut supply. What happens to asset prices? The market's the market. I don't control it. You don't control it, right? The government doesn't control it. The market's the market. It goes on supply and demand. So when you cut supply, demand goes through the roof. Now, that's what's happened. Have you ever heard of used cars going up in value? That's a depreciating asset. Now think about it when it comes to an appreciating asset. You cut supply to an appreciating asset, the demand's going to go up. What does that do to prices? It just rises. So now's the time to get into the market. Better time than never. If you don't get in now, you're going to kick yourself in 10 years' time, 100%.
Awesome. Oh, well, thank you so much, Zah, for all that information for the listeners out there. Thank you for your questions as well. Massive help for everyone.
My pleasure. And guys, if you've got any more questions, please get in touch with Dan. We love these Q&As. And until next time, we'll see you later.
Thanks, guys.